The Pensions and Lifetime Savings Association says you need £32,700 a year for a moderate retirement in 2026. That's the official figure. It's quoted by pension providers, repeated in financial press, and used by thousands of people to calculate whether they're on track. But when I looked at what that number actually includes, and then talked to real retirees, people who own their homes outright, draw a state pension, and get on with their lives, most of them were spending between £20,000 and £25,000 a year. Comfortably. Not scraping by. Comfortably. So the question is, where is the extra £10,000 going? Is it going into your retirement, or is it going somewhere else? In this video, I'm going to show you exactly how the £32,700 figure is constructed, why two specific spending categories inside that figure are inflated by roughly 40%, and what your real number probably looks like if you strip out the assumptions that don't apply to your life. Because the risk here isn't running short in retirement. For a lot of people who watch this channel, the risk is working years longer than you actually need to, chasing a number that was never really yours to begin with. If you're within 5 years of retirement and you want clear, honest numbers that apply to your actual situation rather than an industry average, hit subscribe now. Every video on this channel is built around that. Let's start with what the figure actually means. The PLSA's moderate retirement standard for a single person is £32,700 a year. That's after tax and after housing costs, so it assumes you own your home outright or your rent is already covered. Housing isn't in that number. Now, the full new state pension in 2026 to 2027 is £12,548 a year. So if you're a single person relying on the state pension as your foundation, you'd need to pull an extra £20,152 a year from your private pension or savings just to reach the PLSA's moderate standard. That's the gap. And here's what struck me when I started looking at this properly. The average mortgage-free retiree I've spoken to or heard from in the comments reports spending around £22,000 a year. Not £32,700, about £22,000. That means the real gap between where most people land and where they need to be is about £9,452 above the state pension, roughly half of what the official figure implies. So why is there a £10,000 difference between what the PLSA says you need and what most comfortable retirees actually spend? The answer is in how the figure is built. The PLSA's retirement living standards are based on focus groups. That sounds reasonable until you look at who those focus groups involve. They're made up of people who haven't retired yet, people who are still working, still planning, still imagining what retirement will cost. And research consistently shows that people overestimate how much they'll spend in retirement. They picture a life full of activity, holidays, new cars, eating out every week. The actual experience tends to be quieter, more settled, and considerably cheaper. There's also a structural incentive here worth naming. The PLSA is the trade body for pension providers. It represents around 1,700 pension companies. Those companies earn fees based on the size of your pension pot. A higher retirement income target means a larger required pot, which means more assets under management, which means more revenue for the industry. I'm not saying the PLSA is deliberately misleading anyone, but it's worth understanding whose interests sit behind any official figure before you treat it as your personal target. I've been there myself. When I first saw the £32,700 figure several years ago, I genuinely panicked. I thought I'd need to work another 5 years just to get close to what they were calling moderate. Then I sat down and tracked what I was actually spending, not what I imagined I might spend, and the number that came back was around £21,000. That changed how I thought about all of it. Let me give you a real-world example of what I mean. Think about someone like Dave, 65, retired 3 years ago. He owns his home outright. He draws a small defined benefit pension on top of the state pension, and between them he receives around £22,000 a year. He goes to the theatre twice a year. He takes a 2-week holiday in Europe. He drives a 7-year-old car he bought for cash, and when I ask him if he feels comfortable, he says he does, genuinely comfortable, not constrained. Dave isn't an outlier. He's very close to the norm among the mortgage-free retirees I've encountered. If you've been carrying the worry that you'll never get to £32,700, that you're behind, that you've left it too late, I want to offer a different frame. The figure doesn't reflect how most people in the UK actually live in retirement. The target is inflated. You're not failing. You may simply be measuring yourself against a benchmark that was never designed around your life. So if the £32,700 figure is higher than reality, the next question is where exactly the inflation is coming from. There are 2 categories that do most of the heavy lifting, and they're both assumptions you can test against your own life. When you look inside the PLSA's moderate budget, 2 line items account for a large part of the gap between their figure and what real retirees actually spend. One is car replacement, the other is holidays. On the car side, the PLSA model assumes you'll replace a relatively new hatchback every 7 years. When you work that out as an annual saving, it comes to around £4,300 a year set aside just for car replacement. That's a serious chunk of the budget. But talk to most retired people who own their homes and aren't trying to keep up appearances, and you'll find they're doing something different. They're keeping their car for 10, 12, sometimes 15 years. They're buying used, or they've decided they don't actually need a car at all, particularly in towns and cities where public transport or occasional taxis cost far less than ownership. The Joseph Rowntree Foundation's Minimum Income Standard Research, which looks at what people actually need rather than what a focus group imagines, found that pensioners on lower budgets typically allocate nothing to car replacement. 0. Not because their lives are impoverished, but because the car isn't the priority they assumed it would be before they retired. Now consider the maths for a moment. If you swap the PLSA's car assumption for a more realistic one, say a used car that costs you around £1,500 a year all in, when you add up purchase price, maintenance, insurance, and tax, you've freed up about £2,800 a year compared to the moderate budget. That £2,800 doesn't just disappear into better retirement comfort. At a 4% withdrawal rate, it represents over £70,000 less that you'd need in your pension pot to retire. That's significant. Holidays tell a similar story. The PLSA's moderate budget includes a 2-week European holiday plus a shorter UK break, and the combined assumption runs to around £3,500 a year. Now, many retirees do travel, and that's entirely reasonable. But the style of travel changes. You're not booking trips around school holidays. You're not paying premium prices because you're constrained to August. You're going in shoulder season, staying longer for less, staying with friends, or choosing destinations that don't require expensive flights. I still remember the afternoon my wife and I sat down with a glass of wine and worked through our actual car costs for the year. We'd bought our Ford Focus for £5,000 cash. It was 12 years old. When we added everything up, fuel, insurance, the MOT, a couple of minor repairs, it had cost us less in that entire year than a single all-inclusive trip to Spain. That was a useful moment. It shifted how we thought about what moderate actually meant for us, rather than for a focus group. The combined effect of more realistic assumptions on just these 2 categories, the car and the holidays, accounts for a substantial portion of the gap between £32,700 and the £22,000 that most mortgage-free retirees actually report spending. But here's the question that comes up in the comments more than almost any other. What about the costs the PLSA's figure doesn't include at all? Things like a new boiler, a roof repair, or the one that no one wants to name directly. Care costs. That's where the real fear tends to live. If you've been watching this and thinking, yes, but what about the costs the PLSA didn't include, then you're asking the right question. Because the moderate figure has a blind spot. It covers what you spend month to month. It doesn't build in the irregular, lumpy costs that every homeowner eventually faces. A new boiler, a roof that needs attention, a driveway, windows that finally need replacing. These aren't dramatic emergencies. They're just the predictable maintenance costs of owning a property over a long retirement. Here's a simple way to think about it. A new boiler costs around £2,500 and lasts roughly 10 years. That's £250 a year. A roof repair might run to £5,000 every 20 years, so another £250 a year in rough terms. That's £500 a year of sinking fund money that most retirement income calculations don't explicitly include. Now, £500 a year isn't going to break anyone's retirement plan. But the point isn't the number in isolation, it's the discipline of planning for it. Compare two retirees. The first one has built £30 a month into a separate savings account for exactly this kind of maintenance. When the boiler goes in January, it's an inconvenience, a phone call to a plumber, a week of cold showers. Not pleasant, but manageable. The second person hasn't set anything aside, and the £2,500 repair either goes on a credit card or comes out of savings they were using for something else entirely. Same cost, completely different experience. The care question is the harder one. Residential care in the UK currently averages somewhere between £700 and £1,500 a week, depending on where you are and what level of support you need. If you need 2 or 3 years of residential care, the cumulative cost can exceed £150,000. The PLSA's moderate figure doesn't attempt to cover this, and it's right not to, because it would make the number completely unworkable as a planning benchmark. Care is treated as a separate layer, but separate doesn't mean invisible. Many people I speak with don't think about care costs as a planning consideration at all until something forces the question. And by that point, the options have narrowed. I used to approach this the wrong way. I had a spreadsheet with 20 separate line items for potential retirement disasters, structural subsidence, long-term illness, all of it. And what I noticed was that the more I planned for worst-case scenarios across the board, the more I convinced myself that retirement was financially unreachable. Then a conversation with someone who'd been through it helped me reframe the question. The insight was simple. Plan for likely, insure for possible. A boiler failing is likely. Structural subsidence is possible. Needing some level of care for a period of time is likely. Needing 10 years of full residential care is possible. Those two categories warrant different responses. For likely costs, a sinking fund approach works well. Set aside a small amount each month in a separate account, not accessible, not visible in your day-to-day budget, and let it accumulate. For possible but large risks, things like extended care, you're into territory where equity release, insurance products, or simply understanding your local authority's assessment threshold becomes relevant. That's a different conversation for a different video. The practical upshot is this. A mortgage-free retiree who adds sensible sinking funds for house maintenance and keeps a modest buffer for care planning will typically land somewhere between £22,000 and £28,000 a year in total outgoings, well below £32,700, and that brings us to the practical question: once you've settled on a realistic income target, how do you actually build a withdrawal plan around it? The PLSA figure assumes you'll spend roughly the same amount every year for 30 years. It's a flat projection. And that's not how retirement actually works. Most people spend more in the early years of retirement, the go-go years, as some researchers call them. You're active, you're curious, you want to use the time. Then spending tends to ease off in the middle years as your pace slows naturally. And in the later years, spending may drop in some areas while rising in others, particularly healthcare. The point is that a fixed income target applied across all three phases doesn't match the pattern of real life. So instead of aiming for a single number you have to sustain forever, it's more useful to think about a flexible baseline that can adjust. Here's what the maths look like for someone with a realistic target. Assume you retire with a private pension pot of £250,000 and you're entitled to the full new state pension of £12,548 a year. Using a 4% annual withdrawal rate from your pot, you'd take out £10,000 a year in addition to the state pension. Combined income, £22,548 a year. That's a number that works comfortably for a mortgage-free single retiree, based on what real retirees consistently report spending. And here's the bit about the hidden maths that the PLSA figure obscures. The car replacement assumption alone accounts for around £4,300 a year above what most retirees actually spend on transport. Swap in realistic holiday costs and you recover another £1,500 to £2,000. Those two adjustments alone close roughly £6,000 of the gap between £32,700 and the £22,000 that most real retirees report. At a 4% withdrawal rate, a £6,000 reduction in required annual income translates to around £150,000 less you'd need in your pension pot to retire on the same quality of life. That's a fundamental shift in the planning picture. I'll be honest, I still check my numbers more often than I probably need to. Last week, I went back through the pension pot projections and found myself wondering whether it was enough. It's a thought that comes and goes, but when I run it against realistic spending rather than the official benchmark, the answer looks quite different. The weight lifts. That's not complacency, it's just using the right inputs. But there's one more thing worth addressing, because even when the numbers look fine, a lot of people still struggle to actually use their savings. And that's a harder problem than the maths. You can have the right withdrawal strategy, the right income target, the right pot size, and still find yourself not spending the money. This is more common than people admit. After decades of accumulation, after years of telling yourself the pot needs to grow and that drawing from it means falling behind, the habit of saving runs very deep. And when retirement actually arrives, the thought of watching the balance decrease, even when everything says it should, feels wrong in a way that's hard to explain. It's completely normal. You've spent 40 years building that pot. Your instinct is to protect it. But the risk that doesn't get talked about enough is not running out of money. It's the risk of reaching your late 70s or early 80s with your pension largely intact, having spent a decade being too cautious to enjoy the years when you had the energy to use it. One reframe that helps is to stop thinking of the number as a target you have to hit and stay at. The PLSA's £32,700 is a rigid benchmark applied to an imagined life. Your actual retirement is not rigid. Your spending will vary. Your needs will shift, and your income can adjust if it needs to. Building in that flexibility, knowing you can pull back if something changes and spend a bit more in a good year, removes a lot of the anxiety that comes from treating a fixed number as the threshold between safe and unsafe. That's the shift, from a number you have to reach and maintain to a plan you can live inside. So let's bring this together. The PLSA's £32,700 moderate retirement figure is not your number. It's an industry benchmark built from focus groups of people who haven't retired yet, and it inflates two specific spending categories, car replacement and holidays, by roughly 40%. Most mortgage-free retirees in the UK live comfortably on £20,000 to £25,000 a year. The gap between the official figure and real life isn't a planning failure. It's a measurement problem. Your job is to find your own number based on your actual spending, your own home, your own habits, and build a withdrawal plan around that instead. If you're within 5 years of retirement and you want honest, grounded numbers that apply to your situation rather than to an industry average, hit subscribe. That's what this channel is here for. Not fear, not inflated targets, just a clear picture of where you actually stand. You don't need to chase a benchmark that was never designed around your life. You need a plan that fits. And that plan is probably closer than you've been led to believe.